Welcome to Talk Tickers, the show where we dive deep into the financial world so you don't have to. Today, we are getting into an instrument that has, well, really taken over short-term speculation. 0 days to expiration options. You've probably heard them called zero DTEs. It has that same kind of manic energy we saw with meme stocks, maybe even a little bit of the crypto craze. So our mission today is pretty straightforward. We're going to break down what these things are, why they are so popular with retail traders, and maybe most importantly, talk about the huge systemic risks they might be building into the market.
And it's a critical topic because, on the surface, the concept is simple. A zero DTE is just an options contract that expires at the end of today's trading session.
That's it. You buy it in the morning and by the afternoon, it's either paid off or it's worthless.
Exactly. It's the end of a long evolution. We went from monthly options to weekly, and then in 2022, the SIBO really opened the floodgates.
How so? What did they do?
They added Tuesday and Thursday expirations. And just like that, you had a daily expiration calendar for the S&P 500.
An option for every single day of the week.
Right. It basically created this always-on, high-speed trading instrument. And the market response was immediate.
Let's talk about that scale. Because this isn't some niche product, is it?
Not anymore. It's been exponential. The volume of zero DTE options jumped 60% in just 1 year, from January 2022 to January 2023.
60%. That's a foundational shift.
It is. And if you look at who's driving it, a lot of it is individual investors.
So the people listening right now.
Very likely. New positions opened by retail investors surged 75% in that same time frame. Today, almost a third of all one-day S&P 500 options trades come from individuals.
So if you're watching the market make a big swing in the middle of the day,
you can be pretty sure zero DTE flows are a big part of that story.
Okay, that sets the stage. Now let's get into the mechanics, because they don't behave like the options you might be used to. A quick refresher for everyone. An option gives you the right, not the obligation, to buy or sell something at a fixed price.
Correct. But with zero DTEs, the key difference is time. Or the complete lack of it. The clock is ticking at warp speed.
Any move that doesn't happen today is irrelevant.
Exactly. And that's the source of this huge high-risk, high-reward dynamic. Which brings us to the Greeks.
Right, the math behind it all. There are two that are super important here, I believe.
Yes. The first is theta. Think of theta as time decay. It's the value an option loses just because time is passing.
And for zero DTE, that decay must be massive. The option's value has to go to zero by 4 p.m.
It's an exponential cliff. The decay is incredibly sharp, especially in the last couple hours of trading. This is why option sellers love zero DTEs. They're just collecting that rapidly vanishing premium.
But if you're a buyer, theta is your worst enemy. You're fighting the clock minute by minute.
Precisely. And that brings us to the second Greek, which is gamma.
This is the one that causes all the fireworks, right?
This is the one. Gamma measures how sensitive an options price is to a change in the underlying stock price. For zero DTEs, gamma is huge, especially for options that are near the current market price.
So a tiny little move in the S&P 500
can cause a massive explosive change in the options value. This is where you hear those stories, turning a few $100 into 10,000 in an afternoon.
But it's also where the big risks come from. That gamma risk you hear about.
Exactly.
I mean, you can see the appeal for the retail trader. It feels like a lottery ticket. Small premium, huge potential payoff, and your money's not tied up.
It is the perfect behavioral trap. It's cheap, it's fast, and with commission-free trading, there's basically no barrier to entry. But what it really encourages is just high-frequency gambling.
So let's talk about the bottom line. With all this retail money flooding in, what's the actual financial result? Are people winning?
No. The aggregate data paints a really clear and frankly pretty grim picture.
How grim?
Between February 2021 and September 2023, retail investors collectively lost over $125 million trading S&P 500 DTEs.
Wow. And is that loss rate getting worse?
It's accelerating. After the full daily calendar was introduced in May 2022, the average daily retail loss jumped from around $240,000 to $350,000 per day.
Okay, but is that just because people are making bad bets? Or is there something else going on?
It's a mix, but here's the really stunning part. About 60% of those losses are eaten up by transaction costs.
Wait, 60%? But I thought these trades were commission-free. How can the costs be that high?
It's the bid-ask spread. Because of that high gamma we talked about, the options are really hard for market makers to price and hedge.
So they protect themselves by widening the gap between the buying and selling price.
Exactly. So even with zero commission, you're paying this massive hidden fee on every trade. It's a huge headwind that's constantly working against you.
And this is mostly happening with simple directional bets, right? Just calls or puts.
Yes. Those single leg options make up 60 to 80% of retail volume, and they are where almost all the losses are coming from.
But there's a flip side to this.
There is, and it's fascinating. When you look at retail traders who use more complex multi-leg strategies, things like iron condors or credit spreads, they actually show positive median returns.
So the instrument itself isn't broken, it's how it's being used. The vast majority are treating it like a slot machine.
That's a perfect analogy. Structure is beating speculation.
Okay, let's zoom out. We have this giant pool of leveraged money making these aggressive bets. This feels like it's bigger than just a retail problem. This is a systemic risk, isn't it?
The big institutions certainly see it that way. It's a massive increase in the amount of leverage in the system, and that has regulators and analysts very concerned.
Talk us through that mechanism. How does this create instability? It all comes down to the market makers, the dealers, doesn't it?
It does. Since most people are buying zero DTEs, the dealers who sell them are left with a structural imbalance. They end up with a net short gamma position.
And that short gamma position forces them to do something that sounds totally counterintuitive.
Right. It forces them to hedge procyclically. This is the most important concept to grasp.
Okay, break that down for me. If the market is rallying hard, my gut says a dealer would want to sell to take profits.
But they can't. If they are short gamma and the market rallies, they are forced to sell more of the underlying index to stay delta neutral. If the market tanks, they are forced to buy into the panic.
Wait, they have to buy into a crash? Why?
To keep their books balanced. Their options positions are moving so fast against them that the only way to offset that risk in real time is to chase the market's direction. It's an automated forced reaction.
So they become an amplifier.
A huge amplifier. It's a feedback loop. Any big move is made bigger and faster because the dealers are forced to pour fuel on the fire.
And this is what led to those really dire warnings. I remember J.P. Morgan talking about Volmageddon 2.0.
That's right. Marko Kolanovic warned that this dynamic could turn a, pretty normal 5% intraday drop into a catastrophic 25% crash.
That's terrifying. But is the market really that fragile now?
It's nuanced. They definitely amplify those big tail risk events. But on a normal day, it's not always chaos. There's actually a consistent flow of option selling right at the market open.
And the dealer hedging against that?
Actually acts as a stabilizer. It can create those intraday reversals you often see, where the market sells off in the morning and then rallies back. So they can be both a source of chaos and a source of stability.
That complexity brings up a question I see all the time. Has zero DTEs broken the VIX? The market's fear gauge.
It's a common misconception, but no, the VIX isn't broken. It's just measuring something different.
How so?
The VIX is designed to measure 30-day expected volatility. To calculate it, it uses options that are between 23 and 37 days from expiration.
So zero DTEs aren't even in the calculation?
Not at all. They're completely excluded. The VIX is blind to this intraday volatility. The fear hasn't vanished. It's just migrated to this ultra short-term window.
Which is why we have new indexes now, like the VIX zero DTE.
Exactly. And that's where you see the disconnect. You'll see the regular VIX Kong around 20, while the VIX CDTE is spiking to 60 or higher. The structure of volatility has fundamentally changed.
And part of that new structure is this idea that we're in a persistent negative gamma state. I saw that in 2024, 100% of trading days tested had negative net gamma.
That's right. The old world where the market would flip between positive and negative gamma regimes seems to be gone. Now dealers are just structurally short gamma every single day.
Which leads us to this really fascinating AI research.
Yeah.
The large language models, the LLMs. Tell us about this obfuscation testing.
Right. So researchers wanted to see if an AI could understand the market's deep structure, not just correlations.
Not just when the news says X, the market does Y.
Precisely. So they stripped all the context from the data, no dates, no company names, no news headlines. They just fed the AI the raw numbers on dealer positioning and gamma exposure.
Forcing it to reason, just from the mechanics and what did it find?
It was pretty profound. Even with no context, the LLMs could detect the pattern of forced dealer hedging with over 71% accuracy.
So the AI figured out the feedback loop on its own.
It figured out who the speculators, forces whom, the dealers to do what. the forced hedging. It proves the instability is hardwired into the market's mechanics now. It's not just random noise.
Wow. Okay, so what does this all mean?
It means we're looking at a dual-edged sword. For sophisticated traders using complex strategies, zero DTEs can be a powerful tool. But for the average person making simple directional bets, they are an incredibly efficient way to lose money.
Which puts the SEC and other regulators in a very difficult position.
A classic dilemma. You want to protect investors, but if you restrict access too much, you get accused of widening the wealth gap, of closing off pathways for retail to generate wealth.
It's a tough balancing act between protection and access.
It absolutely is. And this brings me to a final thought, connecting back to that LLM research. The study found that the AI could still detect these structural constraints, this forced hedging, even as the actual profitability of trading those patterns was declining to zero.
So everyone knows the pattern, and the easy money is gone.
Right. But the key thing is, the participants are still forced to react to it, whether it's profitable or not, which raises a really fundamental question. How much of the price action we see every day is driven by actual conviction about a company's future value? And how much is just automated systems reacting to a structural flaw they can't escape?
The ghost in the machine. Are we watching a market driven by belief or just by its own internal automated mechanics? That is a very big question to think about. Thank you for joining us on this deep dive.